And this is Real Estate Underground.
Greetings and salutations, Real Estate Undergrounders. This is Ed Matthews with the Real Estate Underground podcast. Thank you so much for joining us today. Today is a really cool interview. This is a gentleman who is doing it. You know, I always ask the question of our guests, you know, if you had to do it over, what would you do? Mr. Jim Lee from Formosa Investing is the prototypical answer that I typically give, which is I would start immediately in large multifamily. And so, Jim, welcome to the show. I'm really excited to have this conversation, and thank you for your time.
Yeah, thanks for having me on the show, Ed.
Yeah, my pleasure. So I've been, you know, I and a member of my team has been stalking you online for quite some time, and really excited that you accepted our invitation to join. But for the folks out there that haven't met you or don't know your background, why don't you talk about your story and how you got here?
Sure. So I obtained my economics degree at UCLA back in 2010. As many of you would know, back in 2008, that was the subprime mortgage crash, and followed by the 2010 European debt crisis. So it was a tough time to find a job right out of college. So I was jobless for a while, and eventually was fortunate enough to land a job as an inside sales rep, working at LoopNet. For those that aren't familiar with LoopNet, it's basically Zillow for commercial real estate.
Yeah.
So I was able to speak to real estate investors, lenders, agents, property manager on a daily basis. And I learned the importance of having multiple stream of income.
Yes.
And that's when I started to have this idea of acquiring a real estate for additional passive income.
Yeah.
And so from there, I started building my real estate portfolio and eventually pivot to become a syndicator because I want to be able to help more people reach financial freedom.
Excellent. And so when you became a syndicator, you were telling me you had a couple of deals that you've just recently have closed on. You want to tell me about those? Sure.
So the first deal that I closed on was a 200-unit apartment building in Orlando, Florida.
Right on.
It's a value-add Class C apartment building built in 1970s.
Okay.
It's in Class A location, but the building is Class C.
Yeah. Well played.
So it has a lot of potential.
Yep.
And the structure, the deal is pretty straightforward. I'm pretty sure most of the audience know, if they know, they've seen a syndication deal. It's just 8% pref or cash on cash return, with a 70-30 split and 2x equity multiple, hold period 5 years.
Yeah, very, very typical. So in terms of, looking at that, obviously you have an economics degree, so you have an affinity for numbers. What is the process when you're looking at a project? What is the process you go through to underwrite and really kind of dig into, a building? And, the fact that you bought a Class C building in a Class A area is, has the potential to be a home run. So congratulations on that. But, what are you looking for? And, what are you looking to avoid, actually? I have a friend of mine that does, checks our work here as an outside underwriter. And, I affectionately refer to him as Dr. No. But because he never likes any deal. And so, it forces us to think about, risk and what the process is that we're going to have to go through to bring this building back to life and get it to, become a valuable asset. So I'm curious what your process is.
Yeah. So for full disclosure, as a syndicator, I'm currently just working on raising capital on the side of raising capital. So I'm not the lead sponsor and I'm not the operator.
That's okay.
But I do look at these. I do look at these deals, and I do underwrite it as well. I look over the numbers.
Sure.
What I realized that how I pick these markets, especially Orlando and Jacksonville, which is the deals where I'm located, where my deal is located. I look at, since the number one thing is the insurance right out there, and why insurance is so important, because it can go up, it can shoot up really high. Like the expense can add up, especially depending on the location. So that's something that I'm like more aware of that stuff, just
Yeah.
double checking that those that we're not going to be, we're going to be fully covered in the certain areas that we pick in. So that's, I have boots on the ground too, like the team,
Right.
property managers,
Of course.
you know, vendors. I even have investors out there as well.
Mhm.
A lot of Californians end up moving to Florida, as you may know, after the lockdown.
Yeah.
So I have like a lot of people, boots on the ground, that can provide me information as well of which areas to avoid and which areas to to invest in as well.
Right on. Awesome. Yeah, I mean, insurance has been a big issue. It's interesting that you always I've heard story after story after story about investors who bought in Florida, and then the hurricane. The name of it escapes me. The one that wiped out Fort Myers and Sanibel and Captiva. And I was talking with an insurance broker who is down in the southeast, and what he was telling me was the insurance specifically for the Sunbelt area, but any in a lot of different areas that are prone to cataclysmic natural events, that the insurance rates were 25, 30, 40, 50% increases year over year, because of the writing, the underwriting that the insurance companies were doing in terms of replacement costs. And it gets really expensive. And if it's really astute that you're paying attention to that. It's much like in Texas, where or anywhere else for that matter, when you go to acquire a multifamily and you pay a premium over what the assessment is. One of the things that I see a lot of investors get stuck on is, hey, my taxes went up. Well, it's because the value of your building went up, right? And if you're not capturing that in the underwriting, you are missing a gigantic, amount of potentially a gigantic amount of expenses that you need to account for as you kind of understand what the risk is of acquiring that building, right?
Absolutely. Absolutely. Yeah. It's just like you said, in Texas, you have to be very aware of the property tax, because that's where it's the highest.
Right. Right. Yeah. I mean, there's a lot of advantages to investing in some of those states, Texas being one of them. But there are a lot of gotchas as well. And you need to have a comprehensive understanding of exactly what your risk portfolio or your risk envelope looks like, so that 2 years from acquisition, you're not having to make that capital call that some of the folks out there right now are having to do. So in terms of asset classes, obviously you went to UCLA, you have an economics degree, so you're really smart. And I would imagine you could probably do a lot of different things. So what drew you into real estate, and then multifamily in particular?
Yeah. So, like I said, my first job was working at LoopNet,
Yeah.
and that kind of just helped me got into real estate. Eventually, I acquired my first deal. It's a 2-bedroom, 1-bathroom condo, and I kind of did everything from A to Z by myself. I found the tenant, run the background check, did the maintenance, and I realized like I wanted to break away from being active because I want to be more passive. So I started to build a system, automate things, and also hire a property manager. And that's when I realized, if I'm doing all of this, why isn't there something bigger that I can do with automation, right? And so that's how I started to explore syndication.
Yeah.
And once I study and learn syndication, everything just kind of makes sense. I don't know if you want me to explain what syndication is to your audience.
Please, yeah, fire away.
Okay. Yeah, so a syndication is basically a partnership between investors who pool their resources into a single investment. This allows you to invest in multi-million-dollar deals like multifamily properties or any commercial buildings. Syndication eliminates much of that risk while sharing the upside. The property generates an income, and it will be split amongst all the investors. So it's a win-win for both the operator and the syndicator.
Yeah.
So, yeah.
Keep going. It's okay.
Yeah. So once I realized about syndication, and I started to realize like when you build single family resident, right? If you acquire 1, 2, 3, 4, 5 venture, you're going to run out of your ability to borrow the loan. The Freddie Mac and Fannie Mae, you can only borrow up to 10.
Right.
The scalability is just not there, right? And so that's how I got into multifamily, because you can build a healthy real estate portfolio by buying single family resident and continue to acquire until you run out of time and money.
Right.
But with multifamily, you can scale into millions of dollars of wealth, and also when you go after 100+ units, you also attract higher caliber, more sophisticated people, higher caliber, real estate agent, lender, property manager,
Right.
so forth.
Yeah, it's the NBA, right? I mean, you're not playing park and rec anymore. You're playing with the big dogs.
Right.
And so, much is expected of you, but if you understand that process, then it's you have the opportunity to create significant generational even wealth, right?
Yep.
Right on. Okay, cool. So, so in terms of the systems, that's one of the things that you mentioned, and actually is part of my world. I'm a former techie, right? So I think in terms of technology and processes, right? And so I'm curious about the processes you've put in place to enable you to manage your business, and what are some of the key things you pay attention to as you manage that business?
Yeah. So something that as an entrepreneur that I've learned is that I need to be able to delegate task away, and I have this issue of that I've done this for years, and I don't think if I was to delegate this task to someone else, that someone will not be able to do the things that I'm expecting them to do. So that's always been a mindset that I had to overcome. And that's something that I pay really close attention to. And now I actually do just delegate a lot of tasks away for people to manage, to automate things, because I'm only one person. At the end of the day, you have to, there's someone for each skill set, for each position that you need help with.
Right.
You just have to find people that complement your skill set. And I think it's done me wonders when I'm able to just allow people to help me instead of just doing everything on my own.
Yeah. So it's it's interesting because the entrepreneur sometimes, and I've been years and years ago, I kind of fell into the trap of, well, just let me do it. I'll get out of my way. I'll get it done because I know what I want, right? And it's a trap, because what it does is, you're a human being, I'm a human being, we require sleep, right? So at some point the gas tank goes empty, and there are hundreds of hours of work that needs to be done, dozens of hours at least, that need to be done. And you are a carbon being who consumes oxygen and requires 6 to 8 hours of sleep. So that takes basically a third of the day off that you can be active. And do you really want to spend 16 hours a day working this deal? We go through a process every quarter, and we're about to go through it again. In June, where I basically look at the processes and the systems that we have in place, and it's a pretty easy scorecard. It's a simple scorecard, and it's what's stressing me out, right? And it's stressing me out because it's not working, because a human being has to intervene at some point in the process to make something happen, and that slows it down, which stresses me out. So when working on the business, the focus is, okay, if a process or a system is stressing me out, we do one of a handful of things. We delegate it to somebody on the team. We hire somebody else to do it. We outsource it, or we automate it. And then the last thing is we stop doing it, right? What if we can't delegate it to either someone in-house or outside the company, and we can't automate it, then it causes the question, should we even be doing it? Right. And, what that does is it trims down, the envelope of things that we have to manage on a day-to-day basis. And it makes our productivity I can't say that I measure productivity at a, we're doing 4 widgets today and 6 widgets tomorrow level. But the fact is that, there is, we're able to move a lot faster, right?
Yeah,
I mean,
absolutely.
systems
And
and technology are force multipliers. They turn a team of 7 people into a team of 20 people,
yeah,
right?
yeah, absolutely. And just to add on to that is that, we're all in the real estate game to what? To become financially free. So we can, just go after our passions, do
Yeah, it's
whatever
about
we
time,
want.
right?
Right, right, exactly. So when you build a system and automate things and you continue to refine it and tune it and let it run itself, eventually that's where you're getting. The
Yeah,
end result is financial, time freedom.
yeah, and then you actually can go on vacation with your friends and family and you can be gone a week or 2 or longer, and when you get back, everything's still running, right?
Hmm.
Some people will be like, well, I'm not needed. The answer is, well, you're not needed for this business, but is there something else you could be doing? Could you, be donating your time? Could you be coaching? Could you start another business, right? And I think if I learned anything in my days in Silicon Valley, it was that systems, at some point set you free, right?
Yeah.
Yeah, cool. All right. So I'm curious. You've obviously you got an exceptional education, and obviously you've worked for really cool companies like LoopNet. I'm curious about your mentors and the people in your life who've given you advice. And so my question is this: what is the best advice you ever got, and who gave it to you?
I would say the best advice I got was for during lockdown, because I used to be a realtor as well. I got my real estate license right after I quit pretty much my W-2 jobs.
Gotcha.
And um one of my investors during lockdown, he introduced me to this podcast show called the Real Estate Guy Radio Show. I don't know if you're
Oh,
familiar with them.
I am. I'm very
Uh,
familiar with it.
okay.
Yeah,
Yeah. So
one of the OGs.
yeah. So I listened to them religiously because I didn't have anything to do during lockdown.
Right.
Couldn't host open house or anything, and they always pitch about syndication, and
Right.
that was how I started to get curious about it and started to learn about it.
Yeah, cool. So, it's interesting. I find, myself, I find mentors in a lot of different places, right? It's, somebody in the business that I happen to meet at a networking event or some sort of meetup. It's a coach that I hire, right? But a lot of the mentors that I have, and actually I was on your website, and, 2 of them, you're standing in between 2 of them that have been my mentors for a better part of more than a decade. And that is, Robert Kiyosaki and Ken McElroy. I've read those books, and I think the way that if you are shy or if you don't have access to meetups or anything like that, one of the best ways to learn how to do what guys like you and me do in this business is read or consume information in some way, shape, or form, right? It doesn't have to be, the regular tactile book, but it can be something. It can be a podcast. It can be like you were talking about. It can be a YouTube video or a series of videos. It can be an Audible book that you listen to. I mean, there's so many ways to learn these days. So I'm curious about your process in terms of how you do it. Um, you know, how do you consume information, when you're trying to learn something? And I'm curious who you're paying attention to in terms of authors or creators these days.
Yeah. So I basically listen to Real Estate Guy Radio Show podcast
Yep.
and the Rich Dad Poor Dad podcast
Yep.
as well.
Yeah.
Because I was a huge fan of his book,
Yeah.
the Purple Bible. That it,
Purple Bible. Yep.
it changed my mindset
Absolutely.
in
Mine
so many
too.
different ways.
Yeah.
Yeah, yeah. So so the from there, that's why I started to attend the Real Estate Guy Radio Show event, and I went to one of the biggest event called Investor Summit. That's
Yep.
how I took that picture with Ken McElroy and Robert Kiyosaki.
Got it.
And so that group of people I follow. That's who I pay attention to, because they always talk about the economics. They're pretty much at the later stage of life.
Right.
I'm pretty sure all of them are financially free, and
I
they're
think
just
it's working out.
yeah, they're just worried about the dollar collapsing.
Right. And, not be, and not being the fiat current of the world and all that. Right.
Right.
I've been hearing Robert talk about, buy gold because the economy's about to head south. He's been doing it for a few years. At some point, he's going to be right, but hopefully not today. Um,
Yeah.
so with regard to your business and how you're looking at it, if you had to start over, what would you do differently?
I would say change my attitude about trying new things.
Okay.
When I was young, I was pretty close-minded. I'm an introvert, and I keep everything to myself, and I wasn't willing to put myself out there like I am today. After becoming a realtor and syndicator, I kind of learned that, it doesn't help in any way, if you don't put yourself out there, if you don't continue to.
Turns out it's a people business, right?
Right. And it's just a matter of getting comfortable, being uncomfortable, and eventually, you're gonna see results. And I'm beginning to see that,
Yeah,
So
clearly.
yeah. So I think that's something that I think about. What was your question? I'm sorry.
No, I was just curious if if you had to do it over, what would you do
Oh
differently?
yeah. So the one thing that you might have heard from Robert Kiyosaki is that there's three sides to the coin. There's the heads, the tails, and the edge, right? I try to stay on the edge by being open-minded. If you want me to give you an example, I can as well.
Yeah, that would be great.
Yeah, so I was born and raised in Taiwan with the saver's mentality, right? In Asian culture, we've been taught if you can't pay for something, you can't afford it.
Right.
In our mind, debt is slavery and cash is freedom. So when I acquired my first condo, I actually bought it with all cash offer. It was a short sale. Took me a year to close it. And after buying that condo, that's when I got serious about real estate. I realized that there's a lot of things I don't know about real estate. So I that's when I read Rich Dad Poor Dad.
Right.
Changed my mindset, and that's what I mean by staying on the edge, right? Because now not only do I know how to save money, but I also know how to use debt, because there's good debt and bad debt, right? So I think I get the best of both worlds by staying on the edge.
Yeah, and that's brilliant. The fact is that if you can effectively, so here's the balance act, right? Though, if you can effectively manage debt, right, and not over leverage. I always cringe at, when I see, when I meet somebody or I see them online and they're like, yeah, I only put 3.5% down and it's not their primary residence. I get nervous for them because, values don't always go up. Rents don't always go up. Sometimes they stabilize, sometimes they go down. Right. And, you've got to have enough equity so that your monthly payment is far less than your cash flow, so that you can actually put money in your pocket, and it doesn't, as Kiyosaki calls it, it doesn't become an alligator and start eating your money, right? And but it's interesting because one of the things that I'm seeing in the marketplace, and I'm curious what your perspective is on it, is there's a whole bunch of operators out there. Arbor just took back, I think, a $230 million asset from a group, because of, from what I heard, it was increase in taxes, as well as the fact that the rents didn't grow as fast as they had projected, and they lost it, and the investors lost about $20 million in equity, which that hurts. But the fact is that a $230 million asset, and I hear $20 million loss in equity, they only put 10% down. And the fact is, like you were saying about buying that condo, and if you don't have debt, there's zero risk that the bank's going to come and take it, right? There are other risks, but there's that. And on the other side, if you're only putting 3.5% down, you could be way over leveraged and find that when your adjustable rate mortgage reprices from 3.5% to 8.5%, oh boy, that's a much different monthly bill to pay, right? And so, there's a balance there that you have to find. I look at, maximum 70%. And in fact, if I can raise more equity, I will in the deals that we do, just for that reason alone. Right. I'm curious what you're seeing out there.
Yeah. I can't agree more. I mean, but just to add on to what you just said, we raise more money, additional capital, more capital than we need,
Yes.
as for reserves, and that's in case of just like the environment we're put in right now.
Winter's
Right?
coming.
Exactly. When interest rates rise, you better have some, dry powder,
Right.
and otherwise you're gonna have to either raise more capital or have that capital call. So
Right. And
you just have to think ahead, way ahead.
yeah. So, I tell people, I think, so I'm by heritage, I'm Irish, right? Which means I'm wired to think in worst case scenarios. I would submit genetically. And so the fact is that when I'm doing, one of these types of projects, I imagine mushroom clouds on the horizon, right? And, so I plan for that. Right. And so when it doesn't happen, we're all pleasantly surprised, and hopefully we make a little more money than we expected. But the fact is that, you've got to plan for it. COVID was a valuable lesson, right? Where you're in California, I'm in Connecticut, two states that kind of led the way in terms of, eviction, state level eviction moratoriums. And, in terms of I know you invest in Florida, but you live in California still, right?
Yes.
Yeah. And, the fact is that a lot of residents took an eviction moratorium as license to not pay rent. And if you, A, didn't do a good job of vetting your new residents, and B, didn't have reserves to get through that period of time, you were in trouble, lots of trouble, right? And so you need to plan for that. And, capital reserves are a huge piece of that. If you're living rent check to rent check on a building and you don't have any reserves, first off, call me, because I would love to buy your building. But and I'm sure Jim would as well. But the fact is that, I refer to it as dead man walking, right? I mean, you're already dead. You don't know it yet, but you're already dead. And you either need a partner to come in and provide those reserves, or you got to figure out something else. Moody's had I've mentioned this on previous shows, but Moody's in January had a seminar that they gave out that they provided. And one of the key things that I took away from it is that 23% of the adjustable rate mortgages that are going to mature over, I think it's the future 12 months, won't be refinanced, because they were priced at 3.5%, 4%, and now, because of the cash flow and the cap rates expanding, the best that they're going to come in at an 8.5, 7.5 to 8.5%, and those buildings won't cash flow anymore. They won't pass a DSCR test, and that's a disaster, right? And the thing is that I look at historically, right? So I'm old. I'm 53 years old, right? So I think in historical terms, I've been through enough of these cycles to know that history repeats itself on a very regular, predictable basis, right? And when you look at the mortgage rates, in the 6 to 8% range, historically, it's normal, right? If you go back, 50, 75 years, a 7% interest rate is fair, and it's normal. And I'm a child of the late 70s and 80s, where my parents paid, gosh, I think it was 18% interest on the house that we lived in. So it's crazy that people got, I think, a little fat and happy about that the interest rates were always going to be at 2, 3, 4%. And this is a bitter pill of reality that they're dealing with right now. So anyway, I'll hop off my soapbox.
Yeah, I mean, thinking back, maybe that's why my parents never wanted to borrow. They
Right?
wanted to use cash. Yeah, because the interest is so high.
Right. And my parents are children of the Depression, right? So my grandparents were Depression era folks, and they never put money in the bank. A funny story about my family: when we cleared out my great grandmother's apartment after she passed back in the mid '80s, my cousin found, I think it was like $10,000 or $11,000 stuffed in the mattress, under the mattress of her bed. Like, that was her bank. And she was 86 years old, and she, I think she was probably a teenager. She was like early 20s, during the impression, and that's the depression, and that's what that cycle taught her, right? And so the whole idea of frugality and saving money, and credit cards are evil and so are the banks, and all that got transferred to my grandparents, who then taught my parents the same thing. And as you said very astutely, there is good debt and bad debt, right? Good debt produces revenue and income, more specifically. Bad debt consumes it, right? Car payments, your own residence, credit cards, you name it, right?
Yeah, well said.
Yeah, cool. So thanks. So Jim, I'm curious, when you are not doing real estate, what do you enjoy doing? How do you spend your downtime?
I like to travel.
Yeah.
Like to travel. I like to go snowboarding, go to concert with friends, and hiking.
Awesome. That's great. And Jim, if somebody wants to learn more about your business, Formosa Investing, or you, and get in touch, what's the best way to get in touch with you?
They can visit formosainvesting.com. It's a website. I wrote a short 20-pager ebook, talks about the real struggle and mistakes I've learned, so you don't have to make them.
Excellent. Well, that's very generous of you.
Yeah, and you can also find me on social media, Facebook, LinkedIn, Instagram at Formosa Investing.
Awesome. Well, Jim Lee, thank you so much for your time today. It was really good to see you, my friend. And I wish you continued success, and I can't wait to hear about the next deal. Congrats.
Yeah, same to you. And thanks for having me.
My pleasure. Good to see you.
All right, take care.